we will begin. Yeah, we'll start things now. So, welcome everybody. Thank you for joining us this morning in relation to this webinar on tax efficiency. For some of you, you will already be resident in Spain, and for some of you, I know from emails, etc., that we've received, are perhaps in the UK, contemplating a move to Spain in the near future, or indeed actually other parts of the world also contemplating a move to Spain. Whatever your circumstances, we hope that today's session will serve you well. On our panel, we firstly have our very own Mr. Paul Griffiths, who should be top of your screen there. Paul is our head of advice in Europe and is based down in our Marbella office in Spain. And Paul will be doing and running through a lot of the meat of the presentation today. We also have our guest speaker, Alistair Spence-Clark of Spence-Clark Chartered Accountants, been based down in Marbella since the late 1980s, I think. Alistair, is that right?
That's absolutely right, yeah.
Fabulous, okay. And then further up the coast, up in Javier, our local planner to the sort of Costa Blanca region is Eleanor Ryan. So Eleanor has given us a wave there. So that's, as I say, Eleanor based up in Javier. And then we have Fiona also on today, giving us a wave. Fiona is based in Madrid. Fiona is actually one of our planners that is focused on the US Americans living in Spain. So although this presentation will be probably more geared towards Brits and probably UK cited issues, a lot of these issues in relation to Spanish taxation anyway are uniform. It's just that there is a more complex overlay with US tax reporting as well, which goes beyond the scope of this particular presentation, but something that we'll be following up and doing in the new year for Americans living in Spain and other countries overseas. So about us, for some of you, you may be already existing clients, you may know us. For others, maybe you're new to us, responding to an advert or what have you. I've seen some of the attendees are also UK financial advisors as well. So a little bit about us. We work with individuals looking to move overseas. We were established in 2010. And we are regulated in a number of jurisdictions. So we're regulated in the UK by the Financial Conduct Authority. We're regulated in Europe, and we are also regulated in the United States by the SEC as well. The advisors that we have that will work with you, that can work with you, are qualified to UK standards, which is UK level 4, with the main bodies, which is the Chartered Insurance Institute, the Chartered Institute of Securities and Investments, and the London Institute of Banking and Finance. They are the main accredited bodies for this industry. So our advisors work to those standards, or alternatively are qualified in Europe to level 5 standard by the Central Bank of Ireland, and are registered as European financial planners as well with the EFPA. So what does all that mean? Well, basically, just because you live overseas does not mean that the quality of advice you should receive should be substandard. We apply the UK standards of advice: clear, transparent, fees, charging, etc. So the level of advice that you will receive from us will be adhere to that. That's about it from me, other than just to say that at the end of this presentation, there will be a survey. So we'd appreciate if you could just fill the survey in once the presentation finishes. That just gives us and aids us in when we create more of these type of sessions in the future. Your feedback is absolutely very welcome. So without further ado, I will hand you over to Paul, who will take us through some of the aspects here of Spanish tax efficiency.
Well, good morning, good day, everybody. Yes, I'm Paul Griffiths. I look after the European operations here at Alexander Peter. And yes, today we are going to be discussing the Spanish taxation efficiencies, the various quirks that's in the system, and how to plan your assets in the right way. Now, there will be various questions which we have received from our attendees today. Unfortunately, we won't get through all of them, but we'll certainly get through as many of them as possible. And of course, we're more than happy to follow up after the webinar itself. I just want to get this very important statement out there. Today's session is informative only. It's not intended to provide you with advice. Advice will be provided to you on a one-on-one confidential basis. Okay. So without further ado, really, let's dive right in. You got those of you who are planning to come to Spain, or those of you who have recently arrived in Spain, need to understand really the two main areas of taxation when it comes to supporting your life here. So these are the various income taxes. And as we can clearly see here, your business earnings, employments, state pensions, and the majority of what we call occupational pensions, they're classified as general income, so renta general, okay? And there's various progressive taxation with a small allowance that's tax-free for you. You then have all the other forms of income, which are mostly classified as investment income. So a lot of you will have investments such as shares, funds, generating small interest from cash, for example. Also, you get dividends on shares, you get income from funds. And from time to time, you'll be selling those assets and generating a capital gain. So all these things come under the investment income regime, renta de ahorro. And we'll be concentrating more on this in today's session. Just before we do and actually go on to take a look at some of these rates, of course, one of the very important questions that has come up, and quite a common theme, is more to do with the UK state pension, and we'll just talk about the UK state pension, and the civil service pension schemes. A lot of confusion about how these are taxed, and perhaps Alistair, if you want to spend just 1 minute talking about how the UK state pension and civil service pensions are taxed in Spain, if at all, of course.
Okay, well, thank you, Paul. Thanks for the introduction, Alex. State pensions are regarded as ordinary pensions in Spain. So your old age pension, as it's often called, is simply treated as earned income, same as an employment. However, civil service pensions are quite different, and that's because of the double tax treaty between Spain and the UK. Civil service pensions, which are clearly identifiable as civil service pensions, are not taxed in Spain. They're only taxed in the UK. However, they do use up in Spain your lower rates of tax and your personal allowances. So if we take an example of 10,000 euros or £10,000 worth of a teacher's pension, for example, then that would extinguish all personal allowances for the individual and use up a good chunk of the lowest tax rate. So therefore, whilst they don't cost money in terms of tax in Spain, they do cost money in the sense that you can't claim any personal allowances because you've used them up. Now, what is a civil service pension? Well, actually, it's not as obvious as it sounds. Sometimes it is, but sometimes it isn't. There is a list of such pensions which are available through the HMRC website.
Thanks for that. So that covers that very early question. So we're going to move on to taking more of a focus on investment income. So let's actually start straight away in terms of what the taxation looks like under the investment income regime. Okay, so there is no tax-free allowance. I mean, those coming from the UK will know that things like ISAs are tax-free. Capital gains tax, there are significant allowances from the UK standpoint. Spain does not have any recognition of such regimes. They do not have any tax-free allowances under this category. So you're straight in at 19% for the first €6,000 gain, as you can see, and then it's a progressive rate that goes up and up and up. Okay. Now, the way that we find a lot of people would look to mitigate this is obviously making sure their investments are remodeled or revamped into something more efficient for those living in Spain. If you're fortunate enough to speak with our advisors in the UK prior to becoming a resident of Spain, then we can plan it correctly so that you don't have to suffer any taxation in Spain. Those that are already in Spain as a resident, of course, there's still plenty of opportunities to rearrange your assets. If we are selling your ISAs, if we are selling your other portfolios, then yes, there will be taxation due, but it's a great way to actually just rebase your capital and start all over again. Now, the interesting point of the Spanish investment income tax regime is that because they do not recognize any tax-free regimes from other countries, you as the holder of these investments got to be very careful. And one of the most common one, which I'm now lead on to another question, is we have a client here, or sorry, a potential client who has a share dealing platform with about 10, 12 different shares paying dividends on a regular basis. They don't take it out to spend from what they've asked. And they've asked whether these dividends that are paid into the actual platform itself are subject to taxation. I'll jump in on this one, Alistair, and you can just confirm if my understanding is correct. So your dividends you get from, for example, your Shell shares once every quarter, once every 6 months, that is seen as an income, even if you don't take out spending.
Correct.
Okay?
That's absolutely
So
right.
therefore, you're going to have to declare this on your annual returns for the following year and pay the progressive rate of tax that starts at 19%. Okay? And even though you didn't ask me this question, I want to expand on it slightly. If you are selling and realizing a capital gain on those shares, even if they are in tax-free wrappers like ISAs, unfortunately, they are subject to the investment income tax regime as well. So
That's correct. That's correct.
Anything you want to add to that, Alistair?
No, not at all. You sell the shares, you're going to produce a capital gain. The one thing I would add is that we rebase everything into euros. So therefore, if you bought some shares, let's say in 2004, I happen to know what the exchange rate was then, you might have had an exchange rate of 140. Okay, today it's 118. If we're lucky. In fact, you made a capital loss because the same shares are actually worth a lot less now in euro terms. So you can't just look at the sterling value or the dollar value. You've got to look at the exchange rate, date of purchase, date of sale, and it's the exchange rate in euros that applies.
Yeah, I think with what you've said about the actual gain itself over a long period of time, there is a quirk in the taxation system relating to what we call unit-linked bonds from UK providers. So from my past dealings, I'm aware a lot of you as a client will be holding unit-linked bonds from the likes of Aviva, for example, from Standard Life, for example. Alistair, if you can just share your thoughts on these bonds because I think we can actually take advantage of them, and they are taxed a little bit differently, aren't they?
Yeah, it's quite a complicated thing to understand, but there is an anomaly in Spanish tax law, in that Spanish tax law focuses on compliant bonds, which are ones designed for the Spanish market. If you have an Aviva UK bond that's unit linked, it's almost certain that it's a non-compliant bond, and non-compliant bonds have a very unusual way of being treated. The tax you pay on those bonds is the growth in the particular year is regarded as taxable income, even if you don't take it out. So if you had a bond worth £100,000 and at the end of the year it's worth £110,000, then you're going to pay tax on that £10,000, even though you haven't taken that money out. Now, the converse is also true, because when you sell that bond, you don't pay tax on the profit between what you paid and what you sold it for, because you've already paid tax in effect on the growth. So the anomaly that we have is a person who comes to Spain and their bond is worth €100,000 on the date of arrival, and they sell it in March, say, and they sell it for €101,000, they're only going to pay tax on that €1,000, regardless of what they paid when they bought that bond. And they could have bought that bond for €50,000, and they're going to avoid tax on €50,000. So it's a very anomalous treatment. It's a mistake in the law, and it's there to be enjoyed by those who can.
Perfect, thank you for that. Well, that's obviously for bonds from the UK, or what we call non-compliant. So do it right with the right planning. You can take advantage of such matters in tidying up your assets. Now, you probably hear me use this phrase, tidy up your assets. Well, tidy into what exactly, Paul? Well, Alice has mentioned non-compliant bonds. So we're now going to talk about compliant bonds. A compliant bond, really, all it is a wrapper. It's an account to invest your funds and enjoy the various tax efficiencies that come with the compliant status. Now, in order to have a compliant bond, first of all, the provider themselves must have freedom of what we call passports and freedom of services into Spain. So you'll find that these providers are based either in Ireland or Luxembourg. Secondly, it is about what you hold within these bonds themselves that makes the compliance works. And I won't get into too much on that because that is a separate conversation. But typically we're talking about investment funds regulated in Ireland and Luxembourg, first and foremost. But what do you get, in terms of efficiency to have a compliant product as a resident of Spain? Well, the three key points is 3 zeros that I formulated. One is that you are not obliged to declare this asset that's sitting in Ireland or Luxembourg on your Modelo 720, which we'll expand on in just a second. There are 0 taxes when you are realizing gains within the bond themselves. So as an advisor, I'd be recommending selling and buying assets from time to time. Those actions, if you had a simple investment account, you'd have to pay capital gains tax. However, within these compliant bonds, there's 0 tax liability. And the last 0 really is to do with if you're holding income-paying funds, which is quite common. And there's income that are distributed within the compliant bond themselves. There's no tax liability within the product. So it makes a great product to accumulate, to grow one's wealth. But what about when you actually want to withdraw for income purpose or for any other purpose? Well, the efficiency part of it is very, very important to reduce the amount of tax you pay when you withdraw. So let's take a look at this. So I'm going to show you an example here. Someone's invested €200,000 and today it's worth €250,000. So first off, we just need to work out how much the actual gain represents of the overall value. So it's made 50,000, so therefore 50,000 is 20% of 250,000, which is the value. You then decide you want to take out 50,000 because you want to buy a new car, for example. So we've got to work out how much you're going to be taxed. Now, because we know 20% of the value of the portfolio at the time is the gain, same math is applied on what you've withdrawn, because every withdrawal consists of part capital and part gain. Okay? Therefore, you take out 50 grand, we know 20% is the gain, so 20% of 50 is 10,000. Now that 10,000 then has to be taxed. And using the investment income tax regime, we know that the first 6,000 euro of gain is taxed at 19%, and the next 50 is taxed at 21%. So you can see the two different rates there in terms of how it's taxed. So the total tax due is 1,980. So in this example, you've made 50,000 euro in gain. You want to take 50 grand out, and because part of it is capital, part of it is gain, you get a very, very small effective rate of tax overall. Okay, so it is a great way to use and consolidate all of your assets that you've accumulated from other countries into one contract, let it grow, allow it to be invested in the way you wish to be invested, and then you can enjoy the efficiency side going forward. I said that I'll be expanding on the Modello 720, okay? Before I get onto the 720, there is one very interesting question which I forgot to ask about taxes on income, and that is to do with rental income. So we've got somebody here who receives rental income, and they want to know under which regime would that be declared, Alistair?
Okay, rental income is treated as general income. It's not treated as investment income, which may seem a little unusual. However, if the rental income is derived from a residential letting in the UK, for example, maybe it's your old home that you decided not to sell but rent out, then as long as you can demonstrate it was a residential letting, you get a 60% deduction on the net rent. So let's just say your gross rent is 10,000 or 10,000 a year, and you've got 3,000 in costs, and you've got 7,000 in net rent. You get a deduction of 60% of that, which is 4,200, leaving the taxable income only 3,800. So whilst it's treated as general income, therefore at higher tax rates, the 60% deduction on residential lets makes it actually quite an attractive proposition.
Perfect.
And I just wanted to add something else. Now, buy-to-let has restrictions on interest and other types of deduction in the UK. In Spain, we have no restriction on deductions.
Okay, now many of you who have arrived in Spain or planning to visit Spain, I think one of the most common thing that comes up on your research is the dreaded Modello 720. Now, the 720 has been around since 2016, I believe, and it is a case of reporting your assets that are outside of Spain. And the general rules are 3 different categories, and if each of the category has more than 50,000 euro, or should we say at least 50,000 euro, then you are obliged to report this. So if you arrived in Spain, say April this year, so when you get to between January and March next year, and you paid more than 50,000 euro for your UK property, all of your 5, 6, 7 different cash accounts that's outside of Spain add up to more than 50,000 euro, and you've got investments, add them all up, it's more than 50,000 euro, then yes, you must file between January and March. There's always been various grey areas and questions going to and fro on this. So I'm going to say a few things and then I'll ask some additional questions of Alistair as well. The actual method of reporting can be very cumbersome, Alistair will tell you. When it comes to cash accounts, you've got to declare every single account that you've got outside of Spain, even if it's got zero in it. If all of it adds up to 50,000 euro or more, you have to put that line by line. Investments, well, look, for those of you who do hold investments in ISAs, portfolios, anything like that, it's not the account itself that gets declared, but it is the individual assets themselves. So if you've got 15 shares in your ISA, then that's 15 lines of declaration, okay? The declaration itself is tedious, but what's scarier, and I'll let Alice jump in here, is what if you get it wrong? Or worse yet, what if you don't declare at all? Alistair.
Yes, this again a very big, complex subject, which is actually subject to the European Court ruling whether it's lawful or not. But basically, the sanctions are pretty gruesome. If you completely forget to file a tax return, and all you forgot to file was a bank account with 50,000 euros in it, or 50,000 pounds in it, your fine, the minimum fine, is 10,000 euros. So you're going to get fined 10,000 euros just for forgetting to do this or not realizing that you had to do it. If you had a portfolio of shares and you had 10 shares, then the fine could be as high as 50,000, because it's 5,000 per data omitted if you do not declare. So you have a quite ridiculous fine system. If you make a small mistake, the fine can be a minimum of 1,500 euros. So I'm not going to go into more detail because it is quite badly written and quite complicated. It's highly contentious. I'm just going to leave it that you don't want to make mistakes with this tax return.
And obviously, we know that it is not an annual obligation to file the 720. However, there are things that you have to look out for to make sure whether you need to file again. I believe, Alistair, if we just stick on investments, for example,
Yeah.
if there are changes to the number of shares or the number of units you're holding within those investments, you are obliged to declare the following year.
Yeah, basically there are three circumstances when you have to declare. One is that the value of each category, when we talked about three categories, of any one of those categories has gone up more than 20,000 in value, you have to report. If you if one of the categories that you hadn't previously reported has now exceeded 50,000, let's just say you had a bank account and it was 50,000 euros or just under last year, but the exchange rate has changed, so that it's now worth more than 50,000 euros. That bank account or that collection of bank accounts must now be declared. And the third situation is if you've actually disposed of any asset. So let's say you had that portfolio of shares and you dispose of one of the shares, you must report that as well. So you have a situation of a highly complex tax return, very difficult to understand, and a very expensive sanction regime. So it's one of those, I mean, for me, it's not a problem because this is what we do, but for most people, it is impenetrable and completely unmanageable. And that's why it's gone to the EU courts for some kind of ruling.
But this really goes on to the importance of, for those with investments, private investments, and you want to keep them or certainly continue investing because that's how you accumulate and make money in the long term. This is why, you know, the most commonly used product is a compliant portfolio for Spain. Allows you to wrap it all up. You don't have to declare on the 720 for the reasons we've already said. And the taxation on it is very, very efficient when you come to withdraw for income or other uses. Do have one last question on the subject of 720. I know this area can be quite complex, Alistair, so let's try to keep more of a top level. Got a client here says that we've got a couple of SIPPs in the UK. So for those who don't know, SIPPs are self-invested personal pensions, so private pension. They read on the internet that SIPPs are declarable on the 720.
That's correct. Without going into complex details, for most people of retirement age, absolutely, or approaching a retirement age, they are declarable as personal assets.
I think when we talked about it, a lot of it was to do with the 720 is on disposable assets, and obviously pensions become disposable from 55, for example, because that's when you can access them.
Yeah, that's where we start moving into quite complex area, but it uses the wealth tax definition as to when it's declarable on the M720. So we now have a piece of already very complex law referring to another very piece of complex law. So again, this is what keeps accountants in business in Spain, and I'm very happy to have these complex regulations, but it's not good for people.
So I think the gentleman that asked this question will certainly follow that up individually, just to you have a better view on it all. Okay. All right. So really, I think the summary on the 720 is that you've got to do it right. You've got to make sure you file it. Oh, someone's just handed me something actually. One very last question on the 720. Got a client who holds gold and silver bars in a vault in London. It's over the 50,000 euro, but are those declarable on the 720?
Amazingly, they're not. This is a really, really insane piece of law. I recommend to anybody who's interested in this sort of thing to just type Spence Clark M720 in your browser, and you'll be taken to 2 separate articles that we've written, which will explain all these weird anomalies. Gold bars are not declarable. Personal loans to companies are not declarable. All sorts of strange anomalies. And I'm just going to finish off with one thing, which will catch a lot of people out, is if you are a signatory on a bank account, it is also declarable, even if it's not your bank account. And that means that if you're a director of a company, you're a trustee, you're an executor looking after a bank account, and it's more than 50,000 euros together with what you've already got, you have to declare that as well.
So yes, so do search that, because I know Spence Clark does a very good Q&A on the 720. Okay. Right, we're now going to move on to another very interesting area, and this is all to do expanding on the whole pension side of things. Of course, we've already touched upon the taxation of state pension and government civil service schemes, so we don't need to talk about that. You then have your occupational scheme. So if you work for, well, let's just say you work for Aviva in the UK, and you have a defined benefit pension, so an end salary pension, those are of course going to be taxed in the UK first and foremost, and then you are having to oblige to declare that in Spain, and if there's more tax due in Spain as a result, then you pay the difference here in Spain. I'm sure Alistair will jump in if I get this wrong.
Yeah, I'm afraid you've quite got that detail slightly wrong. Pensions are only taxable in Spain unless they're civil service pensions. Therefore, if you have an Aviva Shell pension, Barclays pension, then the UK PAYE office should give you a code number which will exempt you from PAYE in the UK, and you only pay tax on it in Spain.
So you have to apply for that. It's not a default. It's not a default situation.
That's absolutely right. Yeah, you have to apply for it.
But the area of taxation we want to concentrate on when it comes to pension is this whole notion of private pensions. So you can see there on the right-hand column, tax as investment income. So we've got SIPs, QROPs, IRAs for those who are US connected, of course. So Alistair, give us a 2-minute little slot on why these would be taxed as investment income as opposed to earned income.
Okay. Again, another anomaly in Spanish tax law. The definition of a pension for income tax purposes is one that is either an occupational pension or a state pension, or it's a social security pension, or it's a Spanish private pension, i.e. a Spanish equivalent of a SIP. Anything other than that under income tax law in Spain is regarded as an investment, because you have contributed to it yourself, sometimes almost exclusively, and the Spanish system says, well, that's not a pension under the general income rules. That is effectively investment income. So we have an anomaly there, regardless of your 40% tax relief in putting the money into the UK SIP. When you take the money out in Spain, it's not regarded as a pension, it's regarded as a fund, effectively.
Therefore, that's why SIPs are declarable under 720 as an investment contract.
Absolutely right. Absolutely right.
So, of course, a lot of people who have SIPs, or a lot of people who transfer to QOPs, for example, they're going to be wondering if they've made a lot of money on growth, what to do, how to be taxed. Of course, there is another quirk in the Spanish pensions regime, which is all surrounding the use of lifetime and temporary annuities. So we're just going to concentrate on a temporary annuity because over the last 10 years, many people have transferred to QOPs, for example. They've left it invested because when they transferred, they couldn't access it. They're now of retirement age. It's made 40%, 50% growth or whatever it's made. And you've got to understand, right, what options are going to be available to you as a client in terms of drawing those assets out to fund your retirement. And as Alistair said, you could simply take it out and be treated as investment income. So if you have made 50% in the last 10 years, for example, then half of what, or should we say a third of what you've made would be deemed to be taxable and you pay the tax on it appropriately. However, for those that know the system, there is the option of utilizing a temporary annuity. And of course, it's not just a flimsy type annuity you must use to qualify for such reductions. You must officially buy a retirement annuity contract with part of your pension fund. And just to keep things simple for purpose of today's webinar here, we're just going to concentrate on buying a 3-year temporary annuity and what would the tax look like on that. Okay, so we're just going to move on to the next slide here. So we have this individual here who've got a QOPs fund, £640,000, and they're ready now to start drawing down some income. We decided, right, they're going to need 96 grand over a course of 3-year period. So we buy an annuity with £96,000. That gets taken out of the QOPs fund itself, and it buys an actual retirement annuity contract. Okay, so this is how the tax is going to work. So basically, we're going to just keep it simple. Every year, they're taking the same amount. So 37,500 euro is what you're going to receive every single year. Because you purchased a temporary annuity of 5 years or less, and Alistair will certainly correct me if I get this wrong, the taxation is only, sorry, let me just rephrase. The deemed gain is only 12% of that annuity payment. And therefore, you are only taxed on that deemed gain of 12. Here, the example, 37,500 euro, 12% is deemed to be the gain, which is 4,500. That 4,500, because it's within the 6,000 euro threshold, is taxed at 19%. Of course, if you do have other investment income in that particular tax year, that takes you over the 6,000 euro marker, just watch out for that, okay? But for this exercise, we're just assuming this is the only source of income for that year. In this case, 19% of 4,500 euro is 855. So we've got a situation here that using the right tools and products to give you the income you need in retirement can actually really, really reduce your tax burden. Okay. Anything you want to add there, Alistair, about the retirement annuity?
No, I think you summarized it really well. The 37,500 that you've withdrawn is going to pay tax at 855 euros. So it's actually a tax rate of just over 2%, 2.5% or thereabouts. So it's a pretty good deal. I would add that the annuity that is bought has to be bought by the administrators of the fund. It's not the beneficiary who buys the annuity. It's the administrator or the trustee of the fund. And in my experience, I found it very difficult to get UK SIP managers to make these arrangements, and it's a bit of a fight, but it can be done, and it's definitely worth it because the tax benefits are considerable.
I think you're hitting the nail on the head there. It's always been difficult from a SIP standpoint. I think the QROPS market, again, very difficult as well in the QROPS market. We're fortunate enough as a firm to actually have access to a couple of actual annuity providers to ensure that there is no holes for the Spanish taxman to attack this regime. Okay, so just sticking with pension, of course, those of you who are sitting there considering moving over from the UK, then this really goes around the whole pension planning side. You know, what do you do with your pension fund? Do you consolidate it? If you do you consolidate it into a SIP? Do you consolidate it into a QROPS? All these questions that you have are only going to be answered by having obviously a proper one-on-one consultation with myself and the team to ensure that we give you the best possible advice. Okay. Lastly, on pension, there is a question around pension. And this is it's quite interesting. I laugh at this because I have this almost once a month. Paul, my tax-free lump sum from the UK pension system, so whether that's a SIP or whatever, is tax-free from the UK, as we know. Is it taxed in Spain, Alistair?
I'm afraid it is, and this is where I underline the importance of anyone moving to Spain to take advice before they arrive in Spain. Unfortunately, Spain does not regard it as tax-free because it doesn't regard it as a pension scheme. It is nothing more than an investment fund, and therefore you take money out, you pay tax on what you take out.
And of course, I think if you're taking a lump sum from occupational scheme, let's use Aviva again as an example, that gets an even worse tax regime because it's not seen as an investment contract at all, is it?
It's not at all, no. So therefore, that's going to be taxed at your top rate of tax, and it might bring you up to the 48% tax rate. So because we get there quite quickly in Spain, around about 50, 60,000. So what I would say to you is that, again, it's so important to take advice before you arrive in Spain. And once you've arrived, if you still haven't taken advice, well, take advice as soon as you can.
Okay, we're now getting towards just the additional different types of tax to watch out for, and then of course the dreaded "we all die eventually," making sure you get your ducks in a row. So the next wonderful tax that tends to come up on everyone's radar is this dreaded Spanish wealth tax. I say dreaded, but it does target the higher net worth, definitely, but it really depends on what you have. I don't think we need to go too deep into this. This slide just shows you the standard rules. Obviously, in Spain, it is split between, I think, six, seven different autonomous regions, which can enforce various quirks. But just really for our audience here, wealth tax is obviously on your worldwide wealth. There is a list. And again, Spence Clark does produce a nice list on what is included in wealth tax and what is exempt from wealth tax calculations. As you can see here, it's the individual that gets a 700,000 euro allowance before wealth tax kicks in. But also, you know, you do get up to 300,000 euro each to take off your main residence. Okay. But of course, this does sort of lead on to, if you are in that category, you know, don't feel that you're going to be clobbered with wealth tax, because there are actually limits to what you'll end up having to pay. And in this paragraph here, And again, Alistair, you can jump in if you like.
Yeah.
There is a limit on the amount of tax payable each year by the individual.
Yeah, I'm just going to say there are 17 autonomous regions in Spain. We actually have to deal with 18 different tax systems with the state. And with wealth tax, there's been an awful lot of playing games by the different autonomous region governments. They're all competing with each other to show their left or right credentials. So, for example, in Madrid, wealth tax is now completely exempt. In Andalusia, we have the 700,000, 300,000 exemption. But if in Alicante, for example, and Valencia, the exemptions are different. So it's very much a regional tax system. Now, moving on to the main point of how wealth tax and income tax work together, there is a general limit of 60%. And what happens is if you use a compliant bond to limit your income, you can actually bring your wealth tax down quite considerably. If you're subject to wealth tax, the compliant bond is one of the easiest ways of planning your income to bring down your wealth tax. It may seem a strange combination, but that's the way it works in Spain. If you're not living in Madrid and exempt, then you may need to look carefully at things like compliant bonds that will help you.
Because obviously it's all based on what is deemed to be taxable income. Yeah. So therefore, it's only the gain on the withdrawal part on a compliant bond, and also only the deemed gain on the retirement annuity contract as well, that is seen as the taxable income.
Yeah, I'm just going to jump in there. The peculiarity of the 60% rule is that it's only long-term gains. Sorry, it's only short-term gains that are regarded as taxable income for this particular purpose. So therefore, if you've kept your compliant bond for more than 12 months, the capital gain on that compliant bond is excluded from the calculation.
Yeah. So yes, I mean, we won't need to go too deeper into this. This is very individualized, the wealth tax. So we now move on to what is very important, really, and this is not just for Spain in general, everybody, this is just a general rule of thumb. No one likes to talk about death, however, it happens to all of us. And I'm always keen to make sure you get your ducks in a row. Whatever you do, you've got to make sure you have a will. You know, you do not want to die intestate and having to go through probate and everything else for that matter. Those of you who have, should we say, slightly more complicated family situations, you know, various marriages, children from previous marriages, things like that, even more important to have wills in place, because they can often, the whole situation can get challenged, gets messy. And for anyone who's gone through it firsthand, like myself, and also assist clients, I've seen it on both sides of the camp, those with wills and those without wills. And I can tell you right now, you want to make sure you have a will. And of course, look, you're in Spain, assets in Spain, you are assessed worldwide as well as a resident of Spain. So make sure you have a Spanish will, okay? Now, this then leads on to the Spanish compliant bond again, but it is very important because the Spanish compliant bond is drawn up as what essentially is a life assurance contract. Any of your liquid assets that you don't need, i.e. non-cash basically, you just want to have it wrapped up in a Spanish contract. You will be able to physically nominate beneficiaries regardless of the relations of those beneficiaries to you. So in the event of your demise, your beneficiaries will simply approach the advisors, ourselves, for example, or can go direct to the providers, provide their IDs, provide your death certificates, they'll dot the I's, cross the T, and they'll pay out. And in most cases, they can pay out without the need for grant of probate. However, if your beneficiaries do live in Spain, then a lot of providers now do insist on the Modelo 600, which is, I think, is a tax declaration that probate taxes have been made. Of course, I think most of our clients, the beneficiaries, 9 times out of 10 tend to live further afield, such as back in the UK, for example. And having the bond itself will make it very, very simple for those assets to be passed on. The last point on this bit is that what you have in the bond doesn't take that money outside of your estate, not by automation, because this is down to your own personal circumstances. But of course, it simply allows the money to get into the hands of your beneficiary so that if they do have estate duty to pay, they've got the assets to pay it. Okay. Alistair, do you have anything you want to add on this matter? I do have one question, so if you want to add something and then I'll ask you the question.
I think the idea that having these bonds simplifies life or death is well made, and when people are in those circumstances, it's anything that makes life simpler is welcome. The UK probate combined with the Spanish inheritance tax formalities can be pretty time consuming and confusing, so it's good to have something that simplifies.
One question is, basically a lady received £800,000 this year, paid, it was from a UK estate basically, they paid about 60 grand in taxes to HMRC, so this is the excess on the nil rate. Well, first of all, do I have to declare, I live in Alicante, so do I have to declare this to Spain? And if so, what would be my potential tax liabilities?
Yes, you do, because you're a tax resident of Spain and therefore you've inherited an asset worldwide, and that is declarable in Spain. The thing to remember is that inheritance tax in Spain, or Impuesto sobre Sucesiones y Donaciones, is a regional tax, and there are very wide differences between one part of Spain and the other, and Madrid comes out on top again, providing virtual total exemption for close family. Andalusia also provides virtually close family 100% exemption, but unfortunately, living in the Valencia region, that is not the case. I did a quick calculation, and the total tax is in fact 109,000 euros on that 850,000 inheritance, but you're entitled to claim from that tax bill the amount of tax paid in the UK, which is 68,000, which 60,000, which works out at 70,000 odd, and so therefore you only have to pay the difference, which is in round numbers 40,000. Okay.
So not too drastic overall, but tells
Yeah.
us move to Madrid, move to Andalusia, and you'll be fine.
Yeah. I mean, in fact, the Valencian system is quite complicated with a whole series of different exemptions that overlay each other. But if you have a prospect of inheritance at the moment and you want to live in Spain, Madrid is the place, or Andalusia, I should say.
Well, that, ladies and gents, really brings an end to this, what has been quite a high-level look of the whole situation. But I think the key takeaway for all of this is those of you who are planning to come to Spain is to speak to our UK FCA regulated team, who will liaise with our European team to make sure we get your assets in the right place before you come. Those who are already a resident of Spain, it's never too late to get your ducks in a row. In actual fact, I would urge you and advise you, it is always best to pay a little bit of taxes now to tidy everything up than just really, I know ostrich don't bury their heads in the sand, so to speak, but rather than burying your head in the sand, because it does no good for anyone, and most importantly to you, because you do not want to be caught out at all. So yes, I want to thank you for listening, and I will hand you back to our illustrious leader, Alex.
Thank you very much. Thank you, Paul. Well, I hope everybody found that of use, those individual subjects. We could have done a far deeper dive and, spent probably the hour on just one of those subjects alone, if not more, I'm sure. So very difficult to, get all of these messages across, and there's a lot of information there, a lot of technical information. if you do have any immediate concerns, requirements, then of course you're free to speak with us. Obviously, Spence Clark as well. I would encourage you, if you could, please complete our questionnaire that will be sent immediately after this presentation. I think as it switches off, then that would be appreciated. Just one of the quick questions that came through is, inside of the Spanish compliant bond, what can be held? Well, pretty much any unitized investment fund that is regulated in Europe. So can you hold an S&P 500 investment? Yes, you can, absolutely. As an index fund, so Vanguard, iShares, etc. Absolutely. So I suppose where we position ourselves is going back to my original point on clear and transparency. That's exactly what you will get from us. Typically, portfolios built utilizing low-cost investment funds, ETFs, etc., but regulated, fully regulated in Europe. One of the other topical areas at the moment is that of ethical investing, green and ethical investing. As a firm, as an individual, I'm a green and ethical finance professional with the Chartered Banking Institute. So we run, in addition to our regular set of portfolios, those with a green and ethical leaning as well. So those can also be placed with inside of those investment bonds that we talk about. So as I say, a lot of information to take in. We hope that you found it of use, and we look forward to speaking with you in the very near future. Thank you very much. Thank you to all the panelists. Thank you, Alistair, for your wise words and contribution. And yeah, thank you all very much.
Thank you, everyone.
Thank you.